Good morning. Welcome to First National Bank Alaska's Workshop Wednesday webinar, The Impact of FOMO on Investing. My name is Jacob Wilson. I'm a business support manager on our marketing team, and I'm happy to be facilitating today's discussion. I'm excited to be joined by several members of our wealth management and trust team to discuss how the fear of missing out can, but probably shouldn't, impact your investing. If you attended our August webinar, Let's Talk Yield, you'll remember Senior Vice President and Wealth Management Director Morgan Neff from that presentation, who is joining us again today. If you missed that one, I encourage you to check it out along all of our other Workshop Wednesdays on our website. Morgan is a leading expert in the investment field, not just in Alaska, but throughout the country. And I love bringing him on these Workshop Wednesdays to share his expertise. Morgan, can you hear me all right?
I can. Can you hear me?
I can. Great. Hey, Morgan, before we get started, I'd like to take just a moment for you to introduce yourself. And I know we have a couple of your team members here today. I'd love if we could have their introductions as well.
Yeah, no, absolutely. I want to first say thank you to everyone. Thank you, Jacob. And I want to say good morning. Happy Wednesday morning to everyone. And hello to my fellow Alaskans watching. And I'm going to deviate a little bit. Found out that my mom and my brother are watching. So I have to say hi to a couple of non-Alaskans down in Texas. So thank you all for joining today. I think today's topic is going to be extremely fun. And while it may not seem like it's relevant to you, I can almost promise you that you have felt this or you have felt some portion of this throughout your life in one manner or the other. It's very relatable. I mean, go back to when you were a kid, the fear of missing out when you got in trouble because you might not have been able to go to a sleepover or go hang out with your friends. This is taken over, and it's now the core fundamental philosophy of advertising and marketing, right? Nike's not selling shoes. They're selling the chance of and the opportunity to be an elite athlete, right? And you don't want to miss out on that. While investing in society has always continued to glamorize the art of the quick dollar and the fascination and inclination that investors and investments should offer unrealistic returns in an even more unrealistic time frame. Interesting enough, there was a report that actually came out today that I thought was interesting, where it said throughout from 1990 to 2020, only 2.4% of global stocks were responsible for all the equity gains. So as we go into this conversation about fear of missing out and specifically picking individual securities or selections, remember, we're not picking on any individual one. We're just trying to show you what a disciplined approach to your financial planning and investing does over the long term. And hopefully by the end of this, you can walk away with a little bit more knowledge about how this makes you feel and maybe ways to help prevent derailing from your long-term financial plans and goals. But before we start and have a little fun, I do want to introduce my two co-panelists today. Lisa Colasar, Senior Trust Officer, and Rich Wiggins, Senior Investment Management Officer. Both are relatively new to Alaska, and both, oddly enough, relocated from Michigan. I mean, it took them 3,500 miles to travel here to realize they lived 4 miles apart in Michigan. So if that's not Alaska for you, I don't know what is. But before we kick it off, we'll start with you, Lisa. Mind telling everyone a little bit about yourself?
Well, of course. Thanks, Morgan. So my name is Lisa Colasar, and as Morgan had suggested, I am a new Alaskan, and I'm so happy to be here. So I have 30 years of trust experience with a CTFA designation. I've worked for a number of companies, and I'm really happy to be here with FNBA.
Thanks, Lisa. Happy that you're here with us. Rich, same question to you. Give us a little bit of background.
Similar background. So I'm also from Motown. Prior to this position, I was the chief risk officer and the head of operations for the Iowa Public Employees Retirement System. And then prior to that, I was the head of risk and strategy for Saudi Aramco over in Arabia. So in a nutshell, I'm an old guy, right? So I have a lot of institutional experience. My hope is to bring an institutional perspective to the bank and the bank's clientele.
No, thanks, Rich. Well, we're going to have fun today. Let's go ahead and start. So,
Morgan, I'm going to jump in really quick before you get too started. I just want to encourage our participants to engage with our presenters today. So if you look at the bottom of your screen, there's a question and answer feature on this Zoom call, the Zoom webinar. And if you click that, you can ask us any question you want. There's really your opportunity to come in and talk to these experts one-on-one. We're going to answer what we can throughout the presentation. And if we don't get to it during, we'll have a question and answer period at the end as well. So I just encourage you to use that and take this opportunity. Thanks, Morgan.
Thanks, Jacob. No, please make it dynamic. We love questions. We love having a discussion. So let's just kick it off and start with the who, what, where, and why of FOMO. So the term FOMO, or fear of missing out, was actually first, started to be used by a marketing strategist in 2000. It didn't really start gaining a lot of popularity until 2004, when it was used in an op-ed piece in a Harvard Business School magazine. However, since then, due to its meteoric rise in popularity and its constant pop culture reference, both the Oxford and Merriam-Webster dictionary has added it in their respective publications in 2013 and 2016. Interesting, I think FOMO may have kicked in with Merriam-Webster because they added it 3 years later. And I was wondering, it was kind of a discussion we were having earlier, whether or not they felt like they were missing out by not including it in them because they didn't think the term had staying power. But I'm going to tell you, it has only grown in utilization and relevance, and the term is ever present today, as 70% of adults in developed countries are surveyed as suffering from FOMO on a daily basis. There are a lot of definitions and ways to describe FOMO, but the one up on the screen I seem to like the most, which is the unsettling and sometimes all-consuming pervasive apprehension that others might be having rewarding experiences from which one is absent, that can lead to compulsive behavior or decisions. Now, I know if we were in a room together, I would definitely not ask anyone to raise their hand if they felt like they could relate to that definition, because it sounds horrific. But I'll raise my hand. I know I felt that. I know I've been susceptible to that. And I've been able to, look at this over a 20+ year investment career and look at ways of trying to mitigate that. Now, I'm gonna pick on Lisa again, and Lisa, I hope you don't mind, but this is very topical to what I would say is one of the largest and most important investment decisions a person makes in their entire life. You started back with us in May, and you've been having a lot of conversations with me about what it was like for me to relocate here from Texas about 3 years ago. And when we started talking, I could feel like you had some pretty epic levels of FOMO in a couple of cases. Can you share your story?
I sure can. I would definitely say I had a couple of large instances of FOMO. Looking for a house for myself and my family. We, like everybody else, have an Alaskan dream when you come up here, and what you think is going to help you make that. And so I found this one particular house which checked all of my boxes, except that it was so far out of my price range that I was willing to bet the farm in order to secure it. I'm going to take out a loan on my 401k. If I have to sell my right arm, I will do so, whatever that takes. And so that process was overwhelming and daunting. So then I had another opportunity, because obviously I didn't buy that house. I had another opportunity to take a look at houses. And if anybody's been in the housing market in 23 around here, the houses were flying off the shelf so fast that you couldn't hardly get in them to see them before they were already pending. So I got into a house with my realtor. It was a cute house. I think it checked 2 boxes, and then it had a bedroom and a bathroom, but it wasn't big enough for me and my family. But I was so concerned that I wouldn't have a house and that somehow I'd be missing out, that I was willing to buy that house just to make it work so we would have a place. And so I definitely had a fear of missing out. That is so true.
It sounds like you went from one, side of the spectrum to the other, where you went to, I'm going to get crazy, I'm going to buy something that possibly I can't afford in the long run, to I'm just not going to be happy. It's not even close to what I want.
Right. Or need. Sure.
Yeah.
Basically, we had probably been living in one room, but at least I'd have had a house, right? And some place to live. And then I also noticed too, as we're preparing for this webinar today, the inundation of other opportunities for FOMO. Our social media is just filled with advertising and things like you want to book a hotel room, and all of a sudden there's everybody wants a hotel room. 15 booked in the last hour. There's one left. It's an amazing price. It's on sale. You got to have it, right? Then we have Christmas coming and Black Friday sales, and those were no exception. Those were just no exception.
Yeah, I'm seeing this. I feel like I'm seeing this daily now. Which I don't know, Lisa, Rich, and Jacob. You can chime in if you saw this, but if you saw the video that was posted around Black Friday this year, and it was this lady that was standing in Walmart in front of a big group of like 60-inch TVs, and it had this big placard on it that said Black Friday special, Black Friday pricing, special Black Friday pricing. It was $649, right? Well, she peels back the placard a little bit and pulls out the the slip that was behind it, and it's the Walmart everyday low price of $649. So again, another one of those situations where the idea that you're going to go out on Black Friday and get a great deal doesn't necessarily intersect with reality. But I look, at this point, I hope everybody can at least say that in the they understand the psychological ramification and the phenomena of FOMO that has on your daily consumption, your consumable items. But that's not what you came here. You came here to talk about how this affects investments. And as easy as it is to say that marketing and advertising use FOMO for consumables, unfortunately, this is starting to psychologically, emotionally attack the people's perception of how to invest. Buying a pair of headphones and regretting that decision is a much different process than making a large investment like the one Lisa was talking about, and having that could have profound negative consequences and regret. So let's get into what this has and the effect that it has on people and their investment decision making abilities. Okay. Now, I want everybody to stick with me on these next few slides because we're going to discuss some investments and trades that we believe fall into this FOMO category. And outside of this one, which I don't think anyone got into the tulip craze back in the 1600s, you might have been involved. And this is in no way to say that we don't think you did well on it or you shouldn't have invested in it. We're just talking about the FOMO aspect of it, the psychological aspect of each one of these. And again, I think every single one of us on this panel today is not here to tell you to not have fun with investing. Investing is supposed to be fun. We're just trying to educate and put some discipline rail guards around it, right? No one wants to go over to your friend's house or be at a social event and start talking about how your asset allocation strategy has really optimized your diversification and your risk-adjusted returns are off the chart. Man, that's boring. That's boring to me. But talking about Bitcoin or tulips, maybe that could be interesting. But today, and most of academic articles around FOMO want to blame social media in a way of elevating the psychological effect. However, you got to go back 400 or 500 years and really look at one of the worst psychological investments that impacted impacted society. We got to look back in Holland in 1634. And back then they didn't have some 17-year-old kid on its Reddit channel talking about the day trade he made where he made 500,000 and you should subscribe and you could do that too, right? No. What did they have? They had gardens. And in those gardens, what did they have? Tulips. Tulips that were imported from the Ottoman Empire and that became a status symbol among the Dutch elite and wealthy. So much so, and maybe this is can classify as a Twitter post or an Instagram post. One aristocrat was quoted as saying, it was deemed a proof of bad taste in any man of fortune to be without a collection of tulips. So socially, it was being communicated that if you didn't have tulips, you basically sucked, right? So you better get on your game, get some tulips in your garden, or you're going to be looked down upon in society. So what ended up happening? And why is this important? Because I want you to pay attention to this situation and this example, and as we get to the last example in this presentation. So FOMO kicks in. The people that have the money, they're starting to rush in and buy tulips because, hey, if this is what makes me look like everyone else that I want to be looking like, I'm going to do that. But then you had the people that were looking at this as a trading opportunity. They were stepping in bidding up, buying up the tulips. And in many cases, they didn't have the money to do it. They were leveraging their assets. They were leveraging, their barns, their cows, in the chance that they could buy the tulips in day one and sell them in day two for a profit. This was an absolutely a strong astronomical rise in tulip rates of almost 5,000%. This happened in less than a year. Tulip prices collapsed in less than 2 months after the peak had reached. And it nearly devastated the entire economic foundation of Holland. So keeping this in mind, this happened well before social media, but again, another fear that people were missing out and wanted to be involved with, the status quo. Now, 400 years ago, now let's fast forward up to 400 years, talk about 1995-ish, right? This is kind of when I started my professional investing career. And, this, everybody's heard of the dot-com bubble, right? Rich, you and I were talking about this the other day. Just to remind you, you're muted, but when you got into the business, you lived through this environment as well. What do you remember about the dot-com situation?
Yeah, I was definitely in the business. When I think of the dot-com, it reminds me a lot of the Magnificent Seven today, where you have, seven mostly tech stocks, Tesla's in there too, accounting for nearly all the market's gains. In fact, the other day you had a fact where what was it? Do you recall? Where you were like Rain Man, you knew exactly what was the number that they've accounted for the gains so far this year?
Yeah, that's good. Thank you. Yeah, from 1995 to its peak in 2000, NASDAQ, which was the index that held all the internet related stocks, rose 800%. By 2002, 2 years later, it had almost completely retraced back down to 80%. So it gave up almost all of its gains.
It was a huge run up and then a huge crash. And today, it reminds me, very similar. So like today, everybody's buying NVIDIA chips because they're in love with AI, artificial intelligence. And back then there was a panic for internet routers. And so back then, everybody front end loaded 5 years of buying for routers because they couldn't get enough of them, just like they are now for chips. And I get it, but a lot of the same, very logical, very believable reasons for owning Qualcomm, Cisco, Oracle, and Microsoft would apply today to Meta, Amazon, Apple, Alphabet. Everybody expected that those companies would be dominant for the next 20 years because they had huge revenue growth. They benefited from so-called network effects and first mover advantage, all these MBA buzzwords. And they were able to outspend on research and development everybody else. So it made sense that competitors would never catch them. But here's the problem as I see it. If you ask yourself how many of the 10 most valuable tech stocks in the world at the peak of that bubble actually beat the market by the time of the next bull market in 2007? And the answer is scary. There's only one tech stock from the 1999 dot-com bubble beat the market by 2007. And so that's what I think of when I think of the tech bubble back then, and maybe what we're experiencing today.
Yeah, no, thanks, Rich. This next one, and Rich, I welcome your comments on this too. And Lisa, this might be one of the more controversial items on the list because of its, multiple utilization. But, personally, in 2020, 2021, anytime I walked into a restaurant or into any kind of social gathering place and people found out or knew that I've been in the investment business for, 20 plus years, I was absolutely inundated with questions about my thoughts on crypto. And it wasn't necessarily about what I thought fundamentally about it, but it was like, oh, which one do you own? And it was, did I own Bitcoin, Ether, Ripple, Dogecoin, Litecoin, Namecoin, Percoin, Gridcoin? You get it. Like there was a lot of options. In fact, if you go back to 2013, there was only a few dozen total cryptocurrencies out there versus the 20,000 different cryptocurrencies that exist today. This is one that I can say is the most relevant that I witnessed with a lot of friends and acquaintances where, this one friend of mine, ended up saving up $5,000 and he got bit by the crypto bug and put it all in one of the currencies. And you know what? It ripped. It went up. His 5,000 went up to 30,000. And here I am. I'm trying to be the pragmatic voice in the room, and I'm like, look, just take your basis out. Be disciplined. Continue on house money, but at least take your 5 out. That way, you've got it. But at that time, every article, every talking head on TV was talking about how every single Bitcoin was going to replace everything and it was going to continue to astronomically go up. And this, my buddy had, this delusion that he was going to be a multimillionaire over the course of the next 8 months. Unfortunately, that particular coin ended up absolutely collapsing, and he ended up losing almost all of his investment. So, again, we're not here to tell you not to have fun. It's just guide rails. Be disciplined around it, and have fun, but know your risk tolerances.
Hey, Morgan, I'm going to jump in. We got a couple questions here.
Yeah.
From the audience. One in crypto and one of the previous, but I think should be a quick answer. Rich, we were asked, do you know what tech stock that was that actually survived?
Yeah, I believe it was Microsoft.
Oh, okay. Gotcha. And then on the crypto, we have a question. Ethereum is up, almost 2,000%. And it just seems like if you do end up picking the right stock, the right cryptocurrency, or in the .com bubble, then you do find those gains. And so what do you do to evaluate those? And because I think a lot of people do feel like they need to find that one or those two that do have those long-term and extremely high gains. How do you evaluate that?
No, it's a great question. And look, this goes to any investment. If you're going to invest in something, just promise yourself you're going to have a strong fundamental understanding of what you're selecting. Okay. Don't buy it because, as Lisa was talking about the other day, you're hearing about it at the water cooler. Don't buy it because everyone in your circle, is buying it and they keep talking about all the winners, right? Look, I don't know too many people that have gone to Vegas and then have come back and have just gloated about their losses. They've always talked about their winners. So always keep that psychological reference in place. And again, we believe that that you should be looking at things like this, but on a very, very disciplined and narrowed approach, and that you should be, as long as your financial picture is capable of it, you should be looking at a more long-term, diversified allocation for the rest of your financial picture.
It's funny you mentioned that. That reminds me of a term that, Rich, I think you use, FOMO. Could you maybe explain that and how, if you do miss some of these opportunities, maybe the upside to that?
Yeah. The cure to FOMO is POMO. So, if tech stocks crash, you'll be glad that you're far, far away from the mushroom cloud.
And what is POMO?
The pleasure of missing out. So the missing out on the crash. So those of us who were around in 2001, 2002, we're glad to the extent that we weren't overweight, all these tech stocks like Cisco that never recovered. So it's still below where it was back then.
Yeah. It's always a risk.
Yeah.
Thank you. And thank you for asking those questions. Please continue to use that question and answer feature.
Sure.
I didn't get to all of them. I'm saving a couple for the end, but please fill that out. Thanks.
So the last example we're going to talk is probably the most recent one, which is, collectively known as the meme stocks. This was such an interesting environment, to the point where, I was telling you, I felt like I was having fun. I'm like, what am I missing here? Because, I grew up, my investment background grew up on, the debt side, but, the debt of companies, looking at companies, and every single one of these companies, except for BlackBerry, was financially distressed going into the pandemic. The pandemic it didn't worsen things. I mean, it didn't make it all that these companies all of a sudden just financially distraught. They were already having issues prior to the pandemic emerging. But then, as you have experienced, maybe personally, or that was just absolutely inundating the headlines, there are these massive gains. I mean, look at AMC up almost 2,700%. Doesn't that feel very similar to the tulips, right? But let's talk about what they were, what has happened, and why what Rich was saying is very relevant in a situation. Because a lot of times, if you don't time it perfectly, which timing, I will admit, is luck. I mean, from a professional investor, if you time the bottom and you time the top, you can come across as good, but 99% of the time it is luck. But AMC's market cap in November of 19, remember, before the pandemic, was 751 million. By June of 2021, during the meme craze, it had ballooned to 69 billion. Now, it has now reverted back to $1.5 billion. But keep this in mind, AMC reported net losses of 4.6 billion in 2020, 1.3 billion loss in 2021, and they're still burning about $1 billion a year as of last year. GameStop, no different. November 2019 had a $396 million market cap. June of 2021 ballooned into a $17 billion market cap. GameStop is still losing money today at an accelerated rate. You know, what's interesting enough is that 2 out of these 5 companies that are on the screen here actually have either filed for bankruptcy or they're in the middle of filing for bankruptcy, which includes Bed Bath & Beyond and Express Inc. You know, Rich, what's that old saying? You know, you never get fired for what?
Oh, you never get fired for taking a profit.
You never get fired for taking a profit. So, look, again, I want to make sure everyone emphasizes this is not to tell you that these were bad investments. In fact, if you were able to capture it, then it's phenomenal. We're just saying that, you know, fundamentally, make sure you understand what you're getting into and don't have the herd mentality. Don't feel like you have to psychologically be involved when you think everyone else is, right? So how can you eliminate FOMO? Well, it's a psychological vulnerability that is embedded in all of us, so you can't, but you can tame it. We heard from Lisa earlier on her house, and I think what she ultimately did is the first step in how to tame that FOMO. She acknowledged that she had it. She acknowledged that she might be, getting over her skis a little, right? She acknowledged she might be settling for something she's going to be unhappy in. And she's still looking, right? So acknowledging that you have it is the first step. Was that a fair characterization, Lisa?
I would say you're right on, Morgan, for sure.
Next is as we were saying, don't break from your rules or stray from your long-term goals. Stay disciplined. We've been massively advocating to have fun in investing. And we think that there is a component of, looking at these, spectacular and very interesting investments as a portion of your investment portfolio. But let's just say, what would you say is if Rich, for you, what's a good percentage that you would be comfortable with in your portfolio to go after, some of these high volatility, high risk reward situations?
Yeah, I think that the message isn't to not do it. It's just to limit it to maybe like 5%, so
Right.
your position isn't huge.
Yeah, but 5%. So if 5% and it goes down to 1%, would you advocate to double down and go back up to 5%? Or would you say
I would
discipline?
not.
Yeah, so say discipline. Re-educating everyone. This doesn't have to do with just FOMO, but we really have emerged from a market where everything just worked. Ask any kind of assets, used cars, watches, houses, everything. We must reset and understand that hitting your long-term financial goals and investing must be viewed as a marathon and not a sprint. Have that mentality. So have the patience, confidence, and vigilance to know that you're putting your money to work in a disciplined manner that is going to need, or that is going to be built and constructed to meet your long-term goals. And lastly, keep emotions out of it. Don't be afraid to sell for a profit. Don't be afraid to not, as Lisa was saying earlier, not move on her dream house, understanding that she could be financially stressed or stressed, period, from purchasing it.
Right.
Remain fundamentally based. Work with, if it's hard for you, work with an expert, work with an advisor. But the biggest thing is don't make an investment based on emotions, because I'm going to tell you right now, if you're going to do it because you like it and you want it to be, somewhat of a hobby, but don't do it thinking it's a quick, rich, scenario, right? So unfortunately, we can't tell you how to eliminate it completely, but hopefully we've given you some tools in order to, one, identify when you're having it, and then how to tame it, how to really mitigate it from possibly derailing you from your long-term goals and financial picture. With that, I'm going to turn it over to Jacob. I want to say thank you to everyone on today's call, but would also like to open it up to any questions.
Thank you, Morgan. I appreciate it. I might have you flip back a couple slides to your GameStop graph there. Yeah, that one. So quick question before I get into some of these others is, what happened with GameStop and these other BlackBerry Express, AMC, and the Reddit communities, Wall Street Beats? Do you believe that that's changed the investing landscape?
A great question. And Rich, I think you have we talked about this yesterday about what's called talking the book, right? And so, Rich had a really good perspective on how much it has changed, especially with the level of communication and forums that are available out there for, investors. Rich?
Yeah, I think you can, the market's much more susceptible to manipulation. You can do what they call front running, or as Morgan says, talk your book. You can buy a stock and then go, hey, I've got a social media following. I think I'll now, promote it on the social media following and then do what they call a pump and dump. I'll run it up and then I'll just get out of it. So I think the market's definitely changed with the advent of social media.
Understood. Understood. Thank you. Yeah, I think that's something that we see a lot of, just because social media is prevalent, some of these online communities. So I want to take just a moment before we get into a couple audience questions, just to kind of bring home, 2 points that we've talked about here. And the first one I'd like to do is just a round robin style answer. Maybe we go Lisa, Rich, then Morgan can finish up. And that is, how do you personally prevent FOMO from impacting your own personal investing?
Well, clearly I've showed that I can't prevent it. All I can try to do is remind myself that it exists, try to stay rational about things that I want to buy, and really make sure and be sure that it makes sense for me. I think for myself is my takeaway on it.
Yeah, I would say, if you can limit it to, like we mentioned earlier, like 5%, no more than that. But I guess one thing I would point out is that it doesn't mean that these investments are necessarily bad. If you go back to that tech stock example, if you'd have then held those tech stocks another decade, many of them made a lot of money. So the message here isn't that you shouldn't make these investments. It's just to try to potentially limit them, because they're not necessarily good or bad.
Yeah. And yeah, lastly, I'll absolutely, agree with Lisa and Rich is, not only acknowledging that you're feeling it, but acknowledge your risk tolerances, right? Know that, leverage works both ways. Know that, these things can go up and they can go down. I think the market in itself, we haven't really seen a 2022 period in a very long time. And I think it reminded people that markets are susceptible. Markets can go down, not just in the, high flying and high risk scenarios. That markets are, markets can sell off and affect you, from a long-term perspective if you're taking too much risk in your own portfolio. I practice exactly what we preach here. Like, I have a great, asset allocation strategy that's steady as she goes, and then I've got a bucket of capital that I go out and I look for really interesting opportunities that have a lot higher risk reward kind of perspective. So I totally understand the feeling. I try to base everything off of fundamental, even if it's one of those positions. But it is one of those things. I will tell you, after 25 years, I've learned to not invest in anything that I don't fundamentally understand. So that is one thing that I've learned the hard way. And that's because of, possibly, taking some chances on things that I didn't understand very early on in my career. But having that feeling of understanding and knowing that there's a thesis behind that investment is really where I'm a massive advocate on, no matter what you're looking at, no matter what asset class.
Thank you. That makes sense. So kind of dovetailing off two things that you just said, Rich, you were talking about some of those short-term investments that did come up and then collapse. They did make money in the long term. And then Morgan saying you don't invest in items that you don't understand. So I am not an investor. I'm a layman, and my friend, brother, cousin tells me about a stock that I don't want to miss out on. I sure have some FOMO about missing out on it. how do I go about evaluating that stock, cryptocurrency, whatever it may be? What's some actionable steps that I could take to find this?
Yeah, I mean, if it's a stock that someone's talking to you about, it's publicly traded, you know, you get to take a look at everything that they're doing, and they're, regulated and federally obligated to do so. You go to sec.gov, you type in the ticker, and you can pull up every single one of their public filings, and you'll get, basically their 10Ks and their Qs are their annuals and their quarterlies, and you have direct insight into what they're doing, how they did it. It's just understanding what you're looking at. If you don't, I would absolutely encourage you to engage with a financial expert, that you can, learn from, or, utilize them as part of your overall strategy, where you're learning from them and also looking at individual stocks or opportunities that you hear and that your friends are getting involved in. But don't shortchange the education part of it. Take the time, and if it feels like it's overwhelming, too time consuming, then leverage the expert. It would be no different than me. I know this is a random example, but if I needed, an underwater welder, it's not like I'm going to jump into the water and start welding all of a sudden. I have no idea what I'm doing, and there's probably not enough research or certifications that I'm going to be able to do to get there. So I'm going to leverage the expert there in that situation. And I wouldn't expect anything less in this one as well.
Thank you very much. I'm going to jump in and get a couple of these audience questions here. I appreciate you humoring me those. I thought there was a couple of good points to come back to. So going to the audience questions. First one, would you recommend mutual funds instead of individual stocks to reduce risk?
Yeah. Rich, feel free to jump in.
I'll take a shot at that one. So mutual funds instead of individual stocks, I'd say yes and no. So the argument behind index funds, for example, is that, hey, most active managers don't beat the index over time. But so many people have gone into index funds that it's almost created a bit of a distortion. And so a lot is written nowadays about how many indexes, particularly the S&P 500, have huge overweights to those largest stocks, the Magnificent Seven that I referred to earlier. So the instinctive response is, mutual fund, be diversified. But then the flip side of that is that, index funds aren't as diversified as you once thought. So I would be a little more thoughtful about it in picking which index you're buying. There are indexes that take a different approach. That, for example, the Russell 2000, which is a big swath of small cap and mid cap stocks, 40% of those stocks in that index are money losing. And so there are other indexes that you can say, okay, I want to own stocks, but I don't want to own the companies that are losing money, or potentially companies that are even making money but not making enough money to cover their interest charges. So it's a little bit of both, to answer the question from Greg.
Thank you. Morgan, I think I'm going to give this next one to you. And what it says is, I'm in my 50s and I haven't started investing. I feel FOMO about missing the opportunity to save for retirement. What should I do?
It's never too late. By the way, great question. I think that is probably one of the biggest fears right now of anyone, is that they've waited too long, they don't know what to do, or that it's too expensive to get started. And the answer to all those questions is it's not too late, it's not too expensive, and let's get you pointed in the right direction, right? I love Lisa's analogy the other day. We were talking about this because it came up in another conversation, and the football analogy.
Get in the game, like right? Got to get the game. Yeah. Well, what I had said was, I really enjoy football. My team's playing on Sunday. My kids had me out shopping all day, and there's like 5 minutes left in the game, and my kids are like, "Well, why bother now? There's only 5 minutes." I'm like, it's at least 5 minutes that I can catch. I want to see the game. I want to see the score. I want to see how it plays out. So as long as you're in the game, then you always have that opportunity.
Yeah.
It's
Get in the game.
only when you don't
Get in the game. That's a great way of get in the game. And if you have questions and you feel like you don't know where to turn, call us. I mean, shameless self-promotion here. Call us. Talk to you. We'll point you in the right direction, or try to at least.
Thank you. And these are great questions. Please keep these coming, and we're going to try to get to as many as we can before the end of this. The next one is, what are your thoughts on personalized investing apps like Stash and other micro investing apps? And I should say, kind of dovetailing on that, is how that has had an impact on the general public's ability to act on this FOMO and investing.
Look, I think anything that is promoting, people investing and putting away for their financial future is promising. The micro investing apps, I think, is wonderful. That's one of the concerns of a lot of investors, young and old, is that they don't have enough to start a portfolio. We now live in a society where you can start with any amount of money, and I think that these apps are phenomenal from an ability to get you involved, get you educated, get you the transparency, but to Lisa's point, it gets you in the game. And so, from that perspective, I'm very bullish on it, and I love seeing it.
But on the flip side, there's some dangers involved, right? Because it gets people investing who maybe haven't done their due diligence about those things.
Well, it doesn't circumvent what the fundamental aspect that I said before. That first and foremost, you should fundamentally understand what you're investing in. But the apps themselves, think of those as the tool in order to get to those investments, right? But nothing should ever circumvent or should eliminate you from eliminate the perspective of fundamentally understanding what you're investing in and how it impacts you over the long term, right? Or taking, again, a marathon, not sprint mentality.
Definitely. So this next one's kind of comes into the group psychology question, I think. So this individual said, it appears investing FOMO may be okay in a bull market, but harmful during a recession. What would you recommend being more aggressive with maybe riskier assets during a bull market?
Would you repeat? Because you broke up just a little bit on the front end of that, Jacob. I couldn't understand the question. Can you repeat that?
Yeah, definitely. Sorry about that.
Yeah.
So I think what's getting at is with these apps that are coming out with, when individuals who aren't maybe investors see that there's a bull market, they hear about it in the news. Well, they'll jump on their apps and they'll start investing. And the question is, is investing FOMO okay during a bull market, but more harmful during a recession, and therefore you can be more aggressive during the bull markets?
No, I think you have to develop a long-term strategy, and you have to remain disciplined to that strategy, regardless of it being in a bull market or regardless of it being in a recession. By the time you hear of it being a bull market, it's already been a bull market, right? They're already saying we're in a bull market because it's technically triggering the bull market rally, right? I'm gonna tell you right now, by the time they come out and say we're in a recession, we've already been in the recession, right? And the market has since started to, get the feet underneath it. So this comes back down to what we were talking about earlier, is like, don't try to time it. Create a strategy that fits your risk tolerances, but long term. We build our portfolios, our portfolio construction, and the way we select our investments are based on a full market cycle, which is anywhere from 5 to 7 years. We're looking at a full 5 to 7 year time frame when we're making and building these portfolios for our clients. We understand that there's going to be short-term volatility in different asset classes, but over the long term, what we are building is to capture proper risk or proper return for the given amount of risk that we've built into the portfolio. So at the end of it, just fundamentally understand what you're doing, and take a long-term approach.
Thank you. So this next question, this is from me. I just want to touch base with each of our presenters today and just ask, if you give one key takeaway to the audience, to everyone that's watching, what would that one key takeaway be with FOMO and investing? So maybe let's start Lisa and then Rich and Morgan finish up.
I think, again, for me, I'm going to stick to emotions. It's easy to allow your emotions to get in a way of a prudent decision. Think about what really makes sense for you.
Yeah, I guess I think the due diligence issue that Morgan brings up is important. I think that the question about stash and micro investing and things like that, it is important to know what you're buying, whether it's an entirely different asset class like crypto, or whether it's, you own equities, but what kind of equities do you own? Big, large companies, small companies, profitable, unprofitable. So you can't go wrong by, reminding people to try to understand what they're investing in so they understand the risk they're taking.
Yeah, discipline. Make sure you're educated. If you feel like it's overwhelming, leverage the help of a financial expert. But again, we want to make sure, have fun with it. Investing is supposed to be fun, and it is fun. It's I can tell you, a couple of my friends, they don't think it's all that fun because they took outside risk for their given scenario. So make sure you're understanding what you're doing, have a fundamental aspect of it, remain long-term focused, and even if you have the financial expert in your corner, you should always want to be learning and being brought up to speed as much as possible, so that you understand and how to work better with your financial professional for the long term.
Yeah, and to dovetail what you just said, Morgan, I just want to finish off here with the question, what steps should someone take if they want to continue this conversation, whether it be that they feel that they missed out, or they just want to discuss FOMO in their own investing strategies? What's some next steps they can take, or that First National can be there for them?
Give us a call. Send us an email. We don't have a 900 number. We're not going to call. We're not going to charge you when you call, and we're definitely going to get on the phone with you to try to help. Send us an email. Set up a time for us. Let's talk. Get in front of us. We're Alaskans. We love talking to the community. We love being part of the community. There is no obligation. Come talk to us. Let us see if what we can help. And if you don't feel like we can, then we absolutely encourage you to go talk to more people. In fact, find someone that that responds well and that you feel like is a good culture and personality fit for you.
Thank you very much. And I'm just going to echo that. If you do need more information on this topic or any other, I really do encourage you to reach out to the Wealth Management Trust team. And yeah, Morgan, Lisa, Rich, I want to say thank you so much for your time. I think this was a great presentation.
It's been a pleasure. Thank you.
Yeah, my pleasure. Thank you all very much.
We did have a couple questions we didn't get to, and we're going to follow up individually with those individuals. I appreciate all the audience participation. I think this was a great discussion that we had. We are going to post a recording of this webinar, which will be available on the website within 24 hours or so at fnbalaska.com/webinar. And with that, thank you again, and have a great rest of your Wednesday.
Bye-bye. Thank you.
Take care.